Okay, we're going to go over annuity and mortgage protection sales training today. And I know it's Monday and I know it's vacation time, and I know you all want to have time off, but you know, I figured I'd get a little education in, as I promised a few reps I would. So I'm going to do it, and I'll try to be as quick as possible about it. But in the long run, we have to understand that this education is exactly what we need to get the big sale. So if you want to earn $100,000 in a week, you can do it through annuities and mortgage protection. It's pretty hard to do it through final expense. Not saying that it's impossible. Give me 1 second. Not saying that it's impossible, but it's quite hard to do it through final expense. If you're trying to earn $100,000, whether it be a year, a month, or in a week, the annuities are the way to go. So with this strategy and these techniques that I give, without a doubt, will help you get that number at least within 12 months. Now, some do it in a month, some do it in 6 months, some do it in a week. You can have a $100,000 week in this industry, and I know it freaks some people out, but it's very possible, and I'm living proof that it can be done. So the annuities are the way to go through that. You can, you know, you guys can also, if you think about it, if you find large numbers and you're not aware of how to use annuities yet, you can use single premium whole life, you know, to help people acquire a large sum of money for their loved ones, and then also on top of that, acquire the cash value earnings. Yeah, Lawrence, $100,000 a week. Well, whether it be $100,000 a year, most people will be happy with 100 grand a year. But if you really want to know how it's done in a week, you either have an enormous downline, and you all know that have been in this industry for quite some time, that you can have a downline that earns you $100,000 a week. There are sales reps even under the age of 30 that earn $100,000 a week. But if you wanted to do 100 grand in a week, without a doubt, you're going to need annuity sales to do it. You can't write that much business in final expense unless you're doing single premiums, you know, or very, very large premiums. I mean, you know, what's the number have to be to per monthly premium in whole life sales to make $100,000 in a week selling life insurance? I don't know, but it's pretty large. So if you want to make $100,000 in a week and you want to really, really challenge yourself and up your game, and even if you don't hit the 100 grand, let's say you hit $10,000, you're still going to be satisfied. You know, you're still going to be very happy. So if I take a zero out of here and I tell you, look, hey, worst case scenario, you earn $10,000, okay? That's going to get you a nice weekly paycheck, and it's also going to get you a nice start to your business. Because what should you do with this money is the next question. So you hit this money, and you got this coming in, and maybe it's not immediate. You got to remember something. It's waiting to get paid. It might be a week to 2 weeks before this happens, you know, where you get your $10,000. But you got to reinvest it. You have to put money into this industry to make money. There is just no other way. I wish to God I would get a hold of a lot of you in the beginning, where somebody told you that you can make, you know, $3,000 to $5,000 a week, and they never told you what you needed to do that. So here I'm teaching what you need to do to get to $10,000 a week. And what you need first is you need your lead resources. I can't repeat this enough. You've got to have your lead resources in. You've got to have it. So you got to have leads. With leads, with being that said, you've got to have good quality leads. Final expense. Everybody's trying to fight to find the cheapest lead. And that's not always good. When I used to advertise my health clubs, I didn't want it to be the cheapest lead. I wanted it to be the most effective resource I could have for marketing. The most effective resource for marketing. So even if you're paying $15, you know, some of you are out there paying $35 a lead for final expense for less quality than we offer or most companies offer. So you've got to be careful when you're new to this industry and you're dealing with these big heavy hitters in the final expense industry that charge a lot of money for final expense leads. So when you get into the industry, you should start to search for final expense leads. You want tele-leads, are very, very qualified. These are basically 24-hour-old leads that have spoken to somebody that have set you up to speak to that prospect. So it's very simple to, hey, Mrs. Jones, I'm doing a follow-up call to the call that you had received yesterday about that final expense information. I'm the rep that handles your area. I'll be in your area tomorrow. You and Mr. Jones around? That's it. That's the whole, you don't need 4 pages of script, guys, to do this. It's very simple. Mortgage, there's also direct mail. The DM. Direct mail leads are good and qualified. Now, 9 times out of 10, that's why these cost so much at your most final expense companies, because they are direct mail leads. The tele leads and or they are TV leads, and those are good too. I would pay good money for a TV lead. They're not bad. Well, I remember working in the senior market at a company, and I got 8 leads. I got 8 TV leads. It was my first day on the job. I set all 8 appointments, not because I was good, but because they were TV leads. So if you're at a company and they offer TV leads, I highly recommend it. You got to come down here to mortgage protection. Now, everybody wants to get into mortgage protection, but they think it's a hard game. They wonder about it and they question. That's why they stick with final expense and they don't get anywhere. I'm not saying you don't get anywhere. You can make a lot of money in final expense. You can make $10,000 a week easily selling final expense life insurance. But if you want to double those numbers and triple those numbers and quadruple those numbers, you need to get into mortgage protection. Mortgage protection equals a lot of annuity sales. I'm not saying I haven't found annuities in final expense, but you can definitely find them in mortgage protection. Demographics are different. You got people who are qualified. They have qualified for loans 9 times out of 10. They got decent credit. They just bought a home. They got money down. They got money, got income coming in because they have a mortgage. Hello, Lawrence. Mortgage protection usually leads to a 6-figure income. It just works that way. But a lot of people get mortgage protection. They get ill about it in some sense where they confuse it. I can simplify mortgage protection for you very easily in your mind to say that if final expense sales equals funerals, funeral costs, burial costs, cremations, that mortgage protection equals the home. So the only difference between the two is you're really covering the home versus the funeral. And you're just protecting these assets and equity as you are in this for the future. Now here you can leave money behind, here you can leave money behind. Here you're protecting the note on the home, here you're protecting the note on the funeral. So a loved one doesn't get hit with that bill and a loved one doesn't lose this. So these are the differences. Are real simple. You're just covering the mortgage is all you're doing, or time to sell the home. If you really want to truly learn about mortgage protection, the goal would be just learn about how to sell the home. Teach people how to get their home sold for the equity inside. Mark Jones, what's up? Robert Weathers, hello. So look, check it out. You got final expense, covers funerals, mortgage protection, covers the home, and annuities cover both. Plus, annuities cover the home, they can cover final expense, and they can cover income for life. Income for life. So these 3 markets are the ones you really want to focus on. Now, if you want to get rid of this one to get into these 2, you got to earn enough money to get into this. Now, these leads are more expensive. The average lead here is $7 to $30. The average lead here is $40 to $80. Big difference, but the long story short is there's bigger premiums involved in here because you're covering the house, okay? The annuities are just one lump sum of money. So it's just one premium, but pays you big. So whatever that premium is, you get a percentage of. Hypothetical situation. We'll get into the sales process in a minute, but just give me a chance to explain this. The annuities got $100,000. Mr. Jones has $100,000 in a 401k, 403b, thrift savings account, cash value in life insurance, wherever it may be, and you put it into an indexed annuity, depending on your scorecard, your earning potential, your income potential, your interest can be 6%, it can be 5%, it can be 8% on the high notes and 10% on the very high levels. To get here, you really need to be pushing some numbers. 5%, 3%, so on and so on, depending on the company you're with and how they have you structured. However, look, think about it. If you sell a $100,000 annuity at 6%, that's $6,000. So it's $6,000, but why were you there? Remember what got you there? A final expense lead or a mortgage protection lead. So you should have sold the MP and the final expense or the final expense also. Make sure these volumes are. Okay, so long story short is that you got the ability to earn a lot of money. You take this number and you make it $1 million. 6%, $60,000. You earn $60,000 on one sale because you explained to somebody the upside potentials, no downside potentials, no fees, little fees if there are any, and protection from the downside volatility of the market, basically. So there's unlimited potential here. Hell, what happens if you find $10 million? You know what I mean? So, and you really can. You don't realize how much money you're passing up inside the home. When you all are inside a house and you're just talking final expense and you don't speak about this, you're passing free money up for your income. You are licensed to sell this stuff. So it's beyond me why people pass it up so much. Let me tell you why. It doesn't earn you residual income. It's just one lump sum of money. But what it can do is effectively help you build your business. So let's give you one. You sell a $100,000 annuity. You get $6,000 in your pocket. You sell a few policies that week. Let's say you got your $10,000 week. What do you do with this money? You go out and celebrate? Do you act like it's $1 million? No, you reinvest it. You take a portion here, you put a portion here, you put a portion here. You take this. The very first thing is you put leads away for the next couple months. You get on a regular lead flow. Why are you afraid of getting 100 leads? You know, when you can't see them all. Is that why? I don't want to be able to see all my leads. I need an overflow of leads that I can't even get to. So you need the flow of leads to come in. You get 100 a week. That's a huge number. That's if you're up there in the upper echelons and you really got this stuff down. If you're new, I'm going to talk about new people. If you're new and you're below 40 leads a week, you're really not cutting it, man. You're really not going to cut it. Everybody tries to do this business on 20 leads a week. That's the very minimum. Now, I'm not telling you don't do that, but you know, upping this ante to 40 leads a week, you're going to get your money back. If you're halfway decent at this, you're going to get your money back at least and make some sales to reinvest. You should save some. Put some away for a rainy day. How should you save? My theory is if you're going to earn interest on your money, why not do it in an index universal life? Why don't you all check out what it would do for your lifestyle and your future to get yourself started in the investment business and look at an index universal life with high interest rates and learn how to overfund them and really put a savings away. You want to put money in the bank too for the backup, for those rainy days. This is the untouchable money. This is the touchable money. And this is the money that is first and necessary. You cannot do this business without this. You've got to have it. $100,000. So let's get into how to do it. Let's get to the nitty gritty, man. Let's learn how to do it. What to say, what to do inside the house. You have a mortgage protection lead in front of you. If you don't, you got to get some, okay? How do you do that? Well, one of the ways is learning about mortgage protection leads is very important. I didn't know anything about them, you know what I mean, at one time. And now I do, and now I know. Why not be the first in the home? Now, some people might think that it's better to be the third or third. It doesn't matter for me. I've gotten that good that it doesn't matter what place I'm at. Because if somebody sold somebody something, the only thing I got to get around is over the phone. So Mrs. Jones tells me, I already bought it. Okay, great. You know what? Hey, Mrs. Jones, guess what? If you shop for a car, you just stop at one dealership unless you've been there with the guy for years. No. So what I'm going to do is just take a look at what I have. 9 times out of 10, I'm able to double the amount you're leaving behind for half the price. I'm able to double the amount you're leaving behind for half the price. And I'll tell you what, a lot of guys are out there selling whole life products that only go up to about 40 grand, and they're just buying the people time. For the same price product, I can get somebody an Index Universal Life and get them $100,000, usually for the same price. Really, some of these products are really amazing, and you just don't know how to work them yet. It's extremely delicate here, though, you know, because on the age of the individual, there's cost of insurance later on that affects these policies. So this is where you need to teach people how to overfund these policies if they're younger. That's why it's important to get one on yourself and start practicing on yourself. Long story short, you get double the amount that most people are leaving behind. But what these individuals are doing is they're buying the individual's time. When you sell mortgage protection, you're not really there. I mean, in many senses, you are there to cover the house, but there's really several roles you can play. The one is to pay the house off. Pay off. Now, there's many ways to pay that off. It's upfront, so there's a timeline. We don't know when the death or injury or heart attack or whatever may take place, because there are living benefits too. So, you know, this can happen in year 10. This can happen in year 30. With mortgage protection, you got 30-year mortgages, you got 30-year refinances, you got 20-year refinances, you got 15-year refinances, you got 15-year mortgages. So you have to know the difference between them and help people. So if somebody's got 30-year mortgage and they die here, your job is to find out in the home whether the other significant other has enough money to take care of this place for the years that the loan is still in effect. So do they have 20 years of income monthly coming in to protect this house? And there's equity built up. If they don't, the answer to the question is what do I do, is to protect the equity. You teach people how to sell the home. It's very simple. So if Mrs. Jones, which I'm going to show you now on this, how this effectively works, I'm going to take two couples. I'm going to do one that's older, one that's not so old. This is a piece of paper, okay? I always tell people, get a clipboard, get blank sheets of paper, and get a pen. And this is what you draw out for the client. So you got Mr. Jones, 65 years of age. Mrs. Jones, 65 years of age. What do we need to know about these two? Well, what you need to know is you need to know their incomes. You've got to understand what the hell they have in place to protect her. 9 times out of 10, you're protecting her. So, first of all, what's the house? How much is the house worth? Just for hypothetical reasons. Total on the house is 200 grand. It's for 30 years. What's the monthly on the mortgage? For my illustration reasons, we're going to do $1,000. So $1,000 a month is what she needs just to pay the mortgage when he's no longer in the picture. So when he's no longer here or out of work, she needs to have $1,000 a month coming in just to cover the mortgage. So at the end of this, all the bills, you got all the bills here. If you're good at this, you want to get good at this, you start listing the bills. I have a list of bills that I can fax you over, and you can use this and go through the bills one by one. You simply say, on average, Mr. Jones, I'm going to find out what Mrs. Jones is going to be left with. And the way I do this is just by asking out what the bills cost monthly on average, 12 months around the year. So, you know, what's the electric bill? It's $200 a month. What's the gas bill? It's $100, $400 a month. I don't know. You know, the list goes on and on. I can shorten that up for you real quickly by showing you something. But at the end of the day, we want to know one quick detail. Out of the two of you, who earns the two of the higher Social Securities incomes? Out of the two of you, who earns the two of the higher? And I'm going to tell you, 9 times out of 10, it's the mister. See, he's got $3,000 a month. Yes, it becomes hers at his death, but it doesn't become hers immediately. The trouble lies in the fact that she has to wait 6 to 12 months in this era of time. By the time he's 85, this wait could be 12 months to 24 months. We never know. We don't know. But right now, it averages about 6 months for her to get this $3,000. Let's say her income is $1,000. Mr. Jones, here's how you ask it too. It's very important how this language that you use comes out properly. Out of the two of you, who earns the two of the higher Social Securities? I do. Okay, what will you be leaving her? I didn't ask what it is. I asked, what will you be leaving her? And then he might say, what do you mean? You mean what is my Social Security? Yes, what do you bring in monthly? I bring in about $3,000. Okay, great. Mrs. Durham, Mr. Jones, did you realize that it takes 6 to 12 months for you to receive that, Mrs. Jones? So for those 6 months, you're going to be relied on that $1,000. Now, I don't know what else you have, so I'm going to ask the question. Mr. Jones, on top of this, do you have anything else you'll receive due to your death? Do you have any stock-based products, 401ks? Do you have anything else that she will inherit? Cash in the bank, things like that? Yes. Okay, what will she receive? Again, I didn't ask him what it was. I'm asking what she was going to receive. I'm making it look like I'm protecting her by this language. I'm not getting nosy and prying into his business. And a lot of your failures come from asking the questions incorrectly. And that's all you have to do. Thanks, Lawrence. So you want to know how that $3,000 becomes hers? It becomes hers due to death. It's Social Security income, okay? So what's going to happen? He's going to die. She's going to survive on this for 6 to 12 months. And then she will get $3,000 a month. Now, what else do you have in place? This is where I find the annuity money. This is where I help people understand where extra income comes from. So, Mr. and Mrs. Jones, what else do you have in place? I have a 401k. Okay, what will she receive from that? I have $250,000. Boom, cha-ching. There's your $250,000 annuity presentation. Don't get all excited. It doesn't mean it's a sale yet. Okay? It's a presentation. Jose, what's up, bro? So what I can do now is I want to show an illustration for this. Hey, Mr. and Mrs. Jones, here's what I have for you. I told you I came today. I want to show you all the opportunities that you have. I want to put it all on the table. I want to make sure you understand that you have options, okay? And I want you to be aware of these options. So for the rest of your life, you can live without the fear of the market volatility, never losing money again, always earning 13% interest on your money annually. And I'm going to show you how, okay? Do you have a computer? Yes. Do you have a printer? Yes. May I use it? I'd just like to print something up so you guys have it. Okay, no problem. This is where you get your illustration. Contact the carrier, get an illustration for this, okay? Hey, I thought we were here for mortgage protection. Yes, we are, but I'm showing you all your options. You have many options when it comes to mortgage protection, and I've been doing this a long time, so just allow me to do my job and give me some time to get all this in front of you. Give me 15 minutes of your time, and I promise you, at the end of this, you'll be thanking me. All right? No problem. All right, let's do it. Get the print up. Got a $250,000 illustration on an indexed annuity, plus 10% bonus. So it means it got $275,000 is where they start. Next year, we'll have about $300,000 put away. Okay? So in 1 year, you showed somebody how to earn about $50,000. They're not, believe me, if you could tell somebody, tell your client, once you know the numbers are good enough, you'd be able to say, look, how would you like it if I could show you a way to earn about 50 grand in 1 year? How would you like it if I could show you how to earn about $10,000 this year? Never lose another dollar to your retirement fund, ever, and always just earn to the upside potentials of the market, never the downsides. There's no broker fees, there's no cost, there's just unlimited access to upside market potential. That's all you have, okay? So maybe not unlimited, But there's a lot of upsides to the market potential. Anyway, you get this illustration in front of them, boom, you got that part done. Now, just sticking with mortgage protection, I go back to this and I say, okay, Mr. Jones, you're leaving $3,000 behind. It takes 6 to 12 months for Mrs. Jones to receive that. Mrs. Jones, for 6 to 12 months, you're going to be living on $1,000. Do you guys have life insurance? This is a very important question too, because the value behind life insurance cash value can change the whole game for you and them. So if they have multiple policies, I'm going to do this quickly. Multiple policies, take the cash value, get it to them, turn it into an annuity, add it to the annuity. You can always add it to the 401k, and you want to find out what the premiums are. So hypothetically, how about last week? I found $668 a month in premiums going towards term products and index universal lives that had a cost of insurance that was going to wipe out the policies in 3 years. So I take this and I get them a policy for $500 a month. That's for $100,000. Their $668 a month was getting them $300,000 each. But they know it's going away. They know that they invested. And I showed them for the next 7 years, if you invest this money, if you invest $668 a month towards products that you'll probably outlive, that's like $48,000 or some shit like that, or $58,000. You get a $48,000 investment, plus you'll never get the $300,000, plus you lose all the cash that's built up into your index universal life products. And how do I prove this? I get the carriers online with me. I get the carriers, their carriers, on the phone, and I prove it. I say, we need to prove this. I work with these carriers anyway. 9 times out of 10, you're probably working with the carrier that they're already in, if you're a broker. And if you're not a broker, you should become one. So you contact the Index Universal Life Company. You find out a couple things: the premium, monthly. You find out the cash value. You find out the COI, the cost of insurance. These 3 things are what you need to find. Once you know this cash value, let's say this cash value is $3,000. All right? And the COI, monthly, cost of insurance, to keep this premium going, comes out of this cash value. While they make premium payments into this cash bucket, this is pulling it out. All right? So this premium payments made to the product goes into the cash bucket, then the cost of insurance yanks it right back out every month. So there's no life to the policy, and the cost of insurance becomes above the premium payment. It eliminates the policy. This premium, $125 a month. They've had this thing for like 35 years. $125 a month for cost of insurance. How much time does that buy them? Plus, this goes up by $10 a month usually. It can go up by $5 a month year after year after year after year. Okay? Some do it monthly. So it's crazy how they work. But $125, that gives them what? Maybe 2 years is what I think I came up with. Something like 2 years. 2 years of time. And that's it. Those policies are gone. The term products in that case were only 7 years old. They had 7 years of life left on them. And then guess what? Instead of paying $5,000 a year for the product that's worth $100,000, they had several. It jumps up to something like $28,000 a year. Can you believe that? So to keep a product like this in place after 20 or 30 years, the company will allow them to keep it if they paid something like $28,000, $30,000, $40,000 a year. It's nuts. So they know that they're not going to do that. So what do? We get them something guaranteed. We want to guarantee that they make it. So I get them a $100,000 policy for $500 a month. I put it on the mail. I get $10,000 final expense because her health was bad. I put it on the female. And this was an Index Universal Life, by the way. 7% interest earning on the cash value by illustration. And I also got them an annuity for $15,000. So in 10 years, here's how this looks in 10 years, the way I would explain it to them. In 10 years, this will be about $30,000. It'll be about $35,000. So this is for both of them. Mrs. Jones dies, he gets the $10,000 plus the $35,000, and he gets all the cash value built up into this policy. So roughly he walks away with, that's $500 a month. I think it's $30,000. He's almost at $100,000 himself. He's something like $65,000, I think, if 10 years goes by and she passed away, due to the cash value built up in this, plus the policy owner, plus the annuity. So the playing field's even. Now, if God forbid he passed away, she gets $100,000. She gets the cash value inside this. It's a couple bucks, $2,000-3,000, plus the annuity. So she walks away with $120,000. So check, you've got to understand how to bring value to the table. You really need to know that there is cash value built up into a product. And if somebody passes away and they're not going to keep that in place, that they inherit that cash. It's very important for you to bring that to the table. Oh yeah, Tabitha, broker. That's it. So long story short, let me explain broker. You can't do this unless you're a broker. You can't sell annuities unless you're a broker. Really, you can't. I mean, if you're with a final expense company, they usually don't allow you to sell annuities. These days, maybe they do. I don't know. Back in the day when I was doing it, they didn't. So you were solely selling one product, maybe two that they have, and that was it. And the premiums are so high on it. We have the best premiums in the world. We have the lowest premium cost for the highest payouts with living benefits and high interest rate earning cash value. So you got all this mixed up together for a big bang boom buck for the client and you. You as the rep earn a big money. So long story short, that particular situation, if I sell that for $500 a month, my contract level, it's like $7,000 or something like that I earn, plus that $15,000, plus that $10,000 one, which was $100 a month. I think in total I saved them $68 a month too from what they were used to spending. So that's $100 a month. That's about $1,200, $1,300, $1,500 there. And the indexed annuity, that's roughly $1,000. Selling a $15,000 annuity. So you got 7, 8, 9, not almost $10,000 in one sale. So you guys are all doing this. I'm trying to get you guys to just do this weekly, but that with these strategies you can do it per sale. But you need to know what you're talking about and what to say and when to say it, how to say it, along with knowing how to present it. And it's not that difficult. It really isn't. I know it sounds real difficult, and it will be difficult in your mind until you start practicing it. So be ballsy inside the hump. I want you to keep it simple first and start making some money. Make the smaller sales. Go for the $50 or $100 a month sale. Once you get to 100, there's no reason you can't get the $300, $600 premiums. They're there. You just need to explain it to people. I'll tell you why they're there. Some people are already spending this a month. Some people already are spending that a month and you're walking away from it. Here's what you're doing. You're adding more life insurance on. Instead of taking all that off the board and giving them one big product for $600 a month, you're adding another $50 onto this, making it $650, and 50 of it's yours, when $650 could be yours. You gotta change your strategies up, guys, and how do you do that? You gotta know what the hell's going on in the home. So again, out of the two of you, who earns the two of the higher Social Securities? I do. I earn $3,000. Mr. Jones, Mrs. Jones, just for my mathematical reasons, what are you leaving behind? What do you have? Well, she's not gonna leave anything behind because his is the higher. Remember this. This is an important sales strategy here. Mr. and Mrs. Jones, I want you to be aware that you will wait 6 to 12 months. You will wait 6 to 12 months for Mrs. Jones to receive that. So the question is, do you have enough money, Mrs. Jones, to afford to live in this home while he's dead, while you don't have that $3,000 anymore? Don't get the answer from them. because in their brain, they may think that they do. Mathematics is what teaches and proves that they don't. So this particular situation, there's no 401k. We have $1,000 a month mortgage to protect. She can't stay there. Their income's $4,000 a month. What are they spending this $4,000 a month on is your question. How about this? Why don't we just get to the nitty-gritty? Let's find out what the hell's going on at the end of the month. Mr. and Mrs. Jones, at the end of the month, when you pay all your bills off, every bill you got, it's all paid off. Do you have, on average, monthly, $500 to $1,000 left over, and which one are you closer to? Which one of these two are you closer to? We're closer to $1,000. Now, guess what? You can feel at ease. You know that they paid all their bills off, plus play money. You got play money out of there too, right? $1,000 a month was left over. That's great. Here's your investment money for the protection of the equity built up into this home. You need to teach the equity in the home, or you will fail. If you don't show proof of equity being built and why they're protecting this house, you're not going to make as many sales. So do this. You do this in front of them. Every time you see me erase this, by the way, that's a new sheet of paper from a clipboard I have. So I'm putting the sheets aside for later use. So here's $1,000 a month multiplied by 12 months in a year equals $12,000 spent in a year on the mortgage. It's all not all going towards the mortgage. So we take the $12,000, we multiply that by, let's do a timeline. Let's show equity. Here's how you sell mortgage protection on a high level. The threat of losing the equity. Not just the house, but the money in the house. The money that they put in. This is how you scare the shit out of them. Times, let's do 10 years. That's $120,000, okay? And we want to divide that. Divide that by 2. That comes to 60 grand. That's about what the mortgage will be in about 10 years. Now, due to good inflation, and you want to add their age. He's 65 now. At age 75, in 10 years, you'll have about $60,000 all the way up to 80, maybe more, depending on inflation on the home and how the economy works. So do you want to lose, let's just take the entire of the two numbers to scare them a little more, because it could be way truer that it's 80 grand, 80 or more. $80,000 is at risk here, okay? So what we want to do, Mr. and Mrs. Jones, is we want to make sure that Mrs. Jones always walks away with the equity in this house, okay? Another sheet of paper. You get that illustration? If none of you wrote that down, if none of you wrote that equation down, I guarantee you right now you're not going to make big sales. So if you don't know that equation right there, you're not going to make big sales. So if you missed that, you need to tell me right now, and I'll put it up again. I want to see who missed it. I want to see who's right and who really wants to get this. So I know damn well that that's a part of this business, is showing the value that you bring along with the value your product brings is not just the payout from the product. It's to protect money. So there's $80,000 here at risk. She can't stay past, she has no way to pay it for 6 months. She has an income of $1,000 a month. You knew that from the beginning. You go back in your paperwork. She has $1,000 a month coming in. She's waiting for $3,000, but by that time she'll be in the arrears. There's no catching up. Within the first 2 months, they're going to put the sticker on the board, tell her to get the hell out. Long story short again, you got 80 grand at risk. What are you going to do? Timeline, 1, 2 years. You buy her 1 to 2 years of time to sell the home and get the equity out. Mrs. Jones, in the beginning, because I'm training you, I missed this, but in the beginning I would have asked, Mr. and Mrs. Jones, would you stay here if Mr. Jones was no longer here? Would you live in this house? Now, where I live in Florida, it's a little different. Most people say, a lot of people say no, that they wouldn't. Up north, where I'm from, Pittsburgh, that they would. You know, they would want to stay in the home. They don't want to move again. Depends on the age and circumstances, of course. If they're really old, you know, they might need a nursing home and things like that. But from that nursing home, we don't want her to lose this money. Who gets this money? 2 people will get this money, her or the bank. This is who she's going against. Now, if they both die together, God forbid you two go together. If something happens and you guys pass together, who gets the house? Who gets the equity in the home? Not the house, the equity inside the house. Would your kids sell the home? Yes. Well, this also protects them. They would be your contingent beneficiary, right? Boom. In their mind, they're painting the picture that this could happen too. So what are you doing by illustrating all this? You're painting a beautiful picture that protects them from the time that it does happen. It's not if, it's when. When it happens, this is what they need in place. So what do? You get them $25,000. If the income is low, in this case, remember, go through your notes, the income is $4,000 a month. After you're done paying your bills, Mrs. Jones, Mr. and Mrs. Jones, do you have anywhere between $500 and $1,000 a month left over? Which one are you closer to? I'm closer to $1,000 a month. Then this is what you really get to use. You want to do a couple things. You want to show them how to use this as an investment. So if you were to do anything, you can't get them return a premium term. So getting them term in this situation is not a good idea. It's going to turn on too quickly. What, they got 10 years of term? You have to do two things. Because of their age at age 65, you have the choice of index universal life or multiple final expense policies. All right? So if they can't get into an index universal life, then you need to fall back on your final expense. If they can't get into the final expense, you get them graded. Now, if they fall to a graded product or final expense and they can't get the big numbers, this is where I teach people how to use annuities to do the same damn job. Think of it this way. If you know that somebody has a $200,000 home and they're looking to pay it off, and they have $100,000 in a 401k, and you know from the past lookbacks of 20, 30-year lookbacks that every 10 years this doubles plus a 10% bonus, this would be $240,000 in 10 years. There's their money, plus some. So this gives you another reason to show an index annuity illustration. This is why all of you are passing up all this money, is because you're not understanding that index annuities can be used for, one, final expense coverages. It can cover final expense. Your final expense needs have mortgages. Why not cover them under mortgage protection? The strategies of mortgage protection and the funeral. You know what I mean? Explain to them that if, hey, look, guess what? I have a product called mortgage protection. It not only covers the burial and funeral, but it also covers the home. Would you like to take a look at that? Watch what happens to your next couple of weeks if you use that line in final expense. People have rent to pay. Significant other passes away, the rent goes on. You're both on the rent, both on a lease, you're both on a mortgage. Get to the nitty gritty, man. Use the indexed annuity, cover that. Guess what? 10 years, you guys will be 75 years old. At age 85, when most people go away to 95, this will double again. You're talking about $480,000 at age 85. Not only is your home paid off, but you have money to leave behind to your kids, grandkids, yourself. Your life is great. You'll never have to worry about money again. It's too good to be true. It may be, but it is true. This is the way it works. So we want to start with final expense, index universal life, final expense, graded products, and show them the illustration for the annuity anyway. Guess what else can happen? If you're smart about this, and maybe they're taking a little bit of money from their 401k here and there, you can get the interest from this annuity, the money that they're making off the annuity to pay for the index universal life, the final expense, or the graded product. You can use the interest earned to get their payments paid for. No money out of pocket. So think about what you did. You covered the equity in their home. They got a house. It's free money now. They got that paid. Not only that, but you might be able to get the mortgage paid through the annuity after the 10th year. You might be able to start pulling money and never have another mortgage payment ever again. That adds another $1,000 a month onto their income, and they're older. They may need it. So there's all kinds of cool things you can do when you understand how to roll and flip money a little bit. Or just math. Just think of it as math problems, and coming up with the best mathematical scenario for them. So if you don't get this, guys, I need you to speak up and ask me questions too. If you have any questions on Facebook, please type it in. And if you're on the webinar, there's a webinar going on too. Please feel free to ask your questions freely. Let's go back here. I want to repeat this one more time, but I'm gonna drop the ages. Now we're gonna take two scenarios. We got younger people, 35-year-old and a 35-year-old. I keep the numbers even. Walk into the house. I got a mortgage protection deal. Hey, let's call them by their first name in most case scenario. You can do that when they're younger. Let's call it, let's go Joe, Paula. Joe and Paula are 35 years old. They just bought a new house or they refinance. Usually it's a new home. So they have a, again, let's just use a $200,000 home. Joe, it says on the sheet of paper, the mortgage protection lead, it tells me, here's what one looks like. Here's one here. This is what one looks like. Don't steal this from me. Tells you the mortgage lender, the individual, their address, phone number, best time of day to call, mortgage amount, $70,000 in this case. This may be a refinance. If you see lower numbers, it might be a refinance. So long story short, Joe, how much is the monthly mortgage? What do you guys pay a month for the mortgage? $1,000. I'm doing this $1,000 thing to keep the numbers even, okay? But I need you guys to remember the scenario. Okay, that's great. So, Joe, do you guys have life insurance on each other? The Social Security question doesn't make any sense here because they don't really have Social Security yet, you know? So, Joe, do you have life insurance coming in? Or do you have a policy outside of work? Do you have a life insurance policy outside of work? Very important question to ask. Because if it's in work, if he gets hurt or injured or laid off or dies, you know, or doesn't work there anymore, that policy's gone. So it's outside of work. No, but they may say that I have one at work. I have $50,000 at work. Okay, but we don't want to count that because God forbid if you were to get hurt or injured, and that's not enough to take care of her anyway, that you want her to have this as retirement because she has to be 60 years of age to collect on your Social Security and you guys are married. Hold on, give me 1 second. I'm not a fan of ULs or IULs, although much cheaper than traditional whole life is quite a lot more of that level term protection. Buying term protection and investing outside the policy separately will ensure the highest face amount and the lowest premium roll amount and increased accumulation in the investment. That's true, Ronald, but they have to qualify also as they do the Index Universal Life. And on top of that, at age 65, when you're dealing with older people, how much term time can you buy them? You know, I have people buying homes now at age 85 years of age. 85 years of age, there's people buying homes today. And it's absolutely absurd. Now, when I run into this, they usually have a younger wife by 10, even 20, 30 years. But, Ronald, think about what you're saying there, is that the term product for an age 65-year-old male will go how long? When the other product will go for life. Now, term and Index Universal Life, if Ronald doesn't understand, or if maybe he does, that the Index Universal Life will allow them to walk away with money because there is no return on premium on that term product at age 65. Now, under that age scope of 50 and below, I believe that that's the best they can do for return on premium on that. You want to do what's ever in the best interest of the client's future, too. Not just for the now, but the client's future. So if I get somebody a term, I'm sorry guys on the webinar, I got somebody posting something, I want to get clear. If I give somebody a term and it's good for 20 years, that's great. They were 65, now they're 85, but they got 10 more years on the mortgage. Okay, I really didn't do much of anything but take their money. You know, I made a sale. That's great. But if you really have to do the right thing, you can also teach them about the Index Universal Life and teach them how to overfund this. If they don't have return of premium term, and they're not able to pay the back end of the house off, you can't, it's stupid to do. If, however, you take an Index Universal Life with higher interest rates on the cash value, you teach them how to overfund it a little bit, and you take the cash value out on this, you can help them pay the back end of the house off faster. But I'm just talking, Ronald, in a sense where if there's no return of premium on the term, or the term isn't long enough, it doesn't make sense for an older individual. Now, for these individuals, it would make sense. I'm not disagreeing that term would work good here, but long story short, if they're older getting them a term product doesn't make sense if it's only going to last 10 years. Paula and Joe are 35 years of age. So you can easily take their income, which we want to know what that is. Joe, what do you do for a living? I'm a welder. I'm a union welder. Okay. So roughly, so what is her loss? I want to ask her loss. If God forbid you were to die, if you were to pass away tomorrow, what is her loss of income? I didn't ask him what he earns. Okay. Be not so direct by your question and get around stuff by going to ask about the protection that she needs in place and know what the hell Paula will lose. What will she lose is the question by his income. I do about $65,000 a year. Paula, how much money would Joe lose if, God forbid, something happened to you? See, reversed it. I didn't ask her how much she earns. I asked her, how much does Joe lose? Joe will lose in income due to your demise. I do about $35,000 a year. So together, you guys are about $100,000 a year, right? So you get about $100,000 income. Now, at $35,000, the question is this. Joe has a higher income than her. He's probably okay. She has a lower income. She has $35,000. How much is that a month? About about $3,000 a month, right? So she's so rough. I don't know if it's less. If somebody can tell me what 35,000 divided by 12 months is, that would be very helpful for me. Then let's say that she loses about $2,500, or she has about $2,500 a month. The mortgage is $1,000, leaves her with $1,500 a month. I want you to scare them with inflation talk. Okay, that's great and everything for today, but you know the price of gas, the price of food is going up, the price of everything's going up. Wouldn't it be good if we could just get Joe to get this house paid off for, maybe not today, but Joe, if we just got $100,000 on you and you're halfway through this, in 15 years you pass away. Here's the great part about this, guys. If nothing happens to you two in 30 years from now, I'm going to show you how to walk away with a big bucket of money, whether it's ROP term or if it's the Index Universal Life. Now, when you put these two side by side, cash value versus return of premium term, the Index Universal Life is usually higher, a lot higher, like 2 times higher. If it's funded correctly and it goes till 30 years and there's no cost of insurance that will kill it, you can get that in place. So do an illustration for them. Before you go to the house, by the way, you should know how to do illustrations before you even walk in the door. You get good at this. You know a $200,000 home that 9 times out of 10, if they're 35, you can cover the whole mortgage. You can get them a policy for $200,000. And let me give you, for instance, what that would cost. Does everybody have the apps that you need to? You have like Mutual of Omaha's app? You know, whatever carrier you're using, you should have the app for them. Okay, that's great. $2,916 a month is what you got coming in. Give me 1 second. What we're going to do here is we're going to get the guaranteed universal life insurance. Do it on male, non-smoker, age 35, $100,000. $68 a month. Now, if $100,000 to cover this guy is $68 a month. We can also look at return of premium term on here too. That's okay also. In this sense, where they're younger, using the term return of premium term product, in both cases, they have to have good, they can't have like a bad driving record, they can't have a bad look back. So doing these illustrations is very important to ask, have you had any surgeries in the past 4 years? Are you diabetic? Are you a cancer survivor, or do you have cancer? It's very important to ask these questions due to the Index Universal Life and the term products underwriting. So it's about double for this. So $150 or $130 a month to cover $200,000 house. plus in the illustration, if we're doing like, you know, they got interest earned on this stuff, that the interest would be, what's 130 bucks a month, multiply that by 30 years. So Lawrence, do me a favor. Can you do, or Elishaba, Boyce, $130 a month multiplied by 12, and then multiply that by 30 years. How much money is that? This term product might be the same. Long story short, they get it all back. You need to have that in your script. Guys, you will get all this money back. So at the end, you're going to get all the cash value back. Everything you have. Call it a savings account. This is a retirement plan. So not only will you have your house paid off, but you retire with this money. Guys, you'll be 65 years of age, eligible to collect Social Security or close to it. It might be 70, 80 years old by then. And you'll have this to sit on. Does your job come with retirement funds? Does it come with a retirement plan? Yeah, I have a 401k. Now, on average, Joe, you might retire with $150,000 to $200,000. But think about it. If you retire with $20,000, $200,000, that's $20,000 for the next 10 years. $200,000 is only $20,000 a year for the next 10 years. It's not that much money. It looks like a lot of money, but it's not. And with lifelines being longer for these people, you need to get them funding big. Okay, so the question still stands. Out of your $100,000 a month, what are you guys putting in? The scary part about young people is they are intimidated by things they don't understand. $46,800 is what they would get back. $46,800 is what they would get back. Plus, that's without interest, you know, so we'll leave it at that. They get this back in 30 years. Whether it's term product or the other, whatever the premium payment is for the term, that's what they get back. If it's an index universal life with higher interest rates, it could be easily $60,000. And then what you're going to do is teach them how to overfund it. The index universal life is just a whole life with higher interest rates on the cash value. If you just think of it real simple like that, has living benefits. If you've got a good product, you want to have living benefits. That's a big point about people. You know, in some of these term products, if they lose their job, they don't have to pay for the product anymore. If they're hurt or injured for life, they get this policy in place for the rest of their life sometimes. There's a lot of odds and ends to the products themselves that you all need to learn. So pick 2 products and learn them this week. Pick an index universal life product, and then pick a term product and learn in and out. Learn it upside down, learn it well, okay? If you think, you don't have to learn on your own, by the way. Contact the carrier and tell them to teach you about it. Say, I'm interested in learning about an index universal life. They say, what do you want to know? I want to know everything. I want to know, how, you know, if I have an average, put a scenario together. I got a client, $100 a month. What does that get them in index universal life? Can we do an illustration that shows the highest interest earning cash value return? So if they were to retire in 30 years, what would be the best option for them? Always think about retirement for young people when you're selling life insurance. Think about them retiring with money. If you're selling final expense, by the way, I need you to remember that final expense, don't just sell on the funerals. That's dumb. Sell on the fact that final expense comes with cash value. So, you know, Mr. and Mrs. Jones, I know you're young today, but if you need, you know, and think about this. You guys out there selling these $20,000 policies, you know, for $50 a month, when this guy could have $100,000 or even $200,000. That's the difference between index universal lives and this final expense stuff. It gets them a hell of a lot more. So if you really want to be, you know, good at this and you want to bring some value to the table, you want to make your sales process simpler and make big money, then show the difference between final expense, the price there, and the price for index universal lives. But remember, the index universal life has what they call cost of insurance. So later on, it could be chewed away due to the cost of insurance. We don't know what that'll be one day. But if you teach them to overfund it, you got to ask the carrier, how can we deflect cost of insurance? You know, be smart about this stuff. Always ask the carrier. Ask the carrier. Go online. Train with the carriers. They got videos. They got websites and things like that for your benefit. Anybody have any questions? I can talk a lot about this stuff, but you know, and there's a million different scenarios you could be put in, and there's probably not one I haven't been in on the steady flow of the average thing that happens in the home. So does anybody have any questions? Anybody have anything that they'd like to ask? How about you guys here on this webinar here? Paul, you got any questions, or whoever's from 708? Anybody have any questions? You guys all going to make $10,000 this week? The cost of insurance. My man Lawrence, he's always about learning. It's called COO, cost of insurance. That means when people make their premium payments to an Index Universal Life product or UL, there's interest earned on these. Now, if the interest is high enough, it can deflect the cost of insurance. Like on cash value, final expense, you got $10,000 payout, face amount, you got $50 a month premium, $25 is going to rent that, and $25 could be going towards the cash value. Same process here. So you're renting the $100,000, and then $50 is going towards, or yeah, $25 is going towards the 100 grand, and then 25 is going towards the cash value. It equals interest every year. So annually, you want a high interest earning product. An Index Universal Life that illustrates on high interest earnings annually. And they can allow you to pick and choose, like indexed annuities. You just have some of the highest interest earning, proof in the pudding from the look back. Look back at these products. Tell the carrier, take a look back at your own products. Listen, when you talk to these people at home offices and things like that, you don't know how long they've been there. They might have been there 2 weeks, and you're asking them important questions vital for the rest of somebody's life. So understand, know what you're asking to get to know if that other individual knows what the hell they're talking about. And usually they do at home office. They're pretty good. And that means the carrier, whoever they are. So an Index Universal Life earns interest. Now, during the ride that they take, like inflation, the cost of insurance goes up. Okay, all carriers increase their premium rates. This isn't locked in, so there could be fees too. Long story short, you can get around all this, but if you teach people how to overfunding. Overfunding means putting more money than the premium actually is allocated to do. So you want to put more premium in. If this is $100 a month, you tell the individual to put $100 extra a month in, and they'll be safe from the cost of insurance and any fees. What we're trying to protect is this, and it earns for them. So this $100 now earns at 7% interest annually, and plus the premium payment is not all interest earned. So whatever extra they put in is all interest earned, okay? It's really good. That's about it. Well, you just Google it and find out what the cost of insurance means. But long story short is the threats there, not only youthful people, is if you use an Index Universal Life on yourself, it's an investment opportunity for you to have money while you're in your older years. And it is a great avenue to put money away. Where are you going to put it in? A savings account at 0.01%? So use these, even if there is fees, even if there is cost of insurance. Learn how to deflect it, defeat it, beat it. Okay. Remember that illustration I taught you guys at the beginning? I told you that my clients had cost of insurance to theirs that was $125 a month. That means while every time they're putting a $50 a month premium payment towards it, $125 is being pulled out of the cash value. So out of that $50, $25 is going towards the cash value. So they're tearing another $100 of the cash value out. Once all the cash value is gone, the policy ends. That's the end of the product due to cost of insurance. But they weren't taught how to, they didn't have high interest rates on this. It was 1.75% that they were earning on the product, along with, maybe it was 3, I'm not sure, but it was low. Along with the fact that they didn't know how to overfund it. So if they were just taught how to put an extra 50 or so bucks a month, the interest would have helped it grow enough to deflect all the cost of insurance. So that's what that means. It's cost of insurance is either, if you don't know what the hell you're doing, it can be deadly to the policy. However, this plays two roles. One, it benefits you as the sales rep to know this shit. Cost of insurance on look for old Index Universal Life products and immediately say, how long have you had this? If somebody's had a cost of insurance policy, Index Universal Life or Universal, fixed Index Universal Life, flexible, premium Index Universal Life. If they've had any of these products, you're allowed to look at these products with the client and figure out what that cost of insurance is versus the cash value and calculate how much life is left due to the cost of insurance eating away at the cash value. I understand what you are saying, Jason. However, I am a financial coach, and my goal is to get my clients insurance over a 20 to 30 year period. You're right, clients as well as some years, but most of them, clients fell into the age group in your example, where clients get the term product to cover that income. Well, look, like I said, Ronald, either way, you know, it does a great job. If you're a financial coach, you should, out of everybody, know that it all depends on how the numbers are put together. So what we're trying to do is teach people how to teach people, and this is good that you bring this up. You know, because if we draw a line down the middle of the paper and we put this term over here, and we put the Index Universal Life here, they both do the job if somebody dies within a certain amount of period of time, right? So they're both interactively somewhat term policies in the beginning. The only difference is that you have the interest on this, on the cash value. You have the overfunding method. You usually got a higher payout sometimes than term. Sometimes it depends. Term a lot of times can be higher than the Index Universal Life in a lot of cases. But I do have products that are same or above, and it can be vice versa. This with ROP is the only way that I would do it for anybody. I mean, I'm not here to, with today's times, taking the math and suggesting to somebody to take $40,000 of their money over the next 30 years and then protect the house is one thing. That's great, you know, but the unfortunate part is a lot of them walk away with paying that and never walk away with a dime because they outlive it. And that's the problem I have with doing it this way. From a financial point of view on their end, if you ask the client after 30 years is up, do you want to keep the money at the end? Yeah, that's great for the return of premium. But if you can't get them return of premium, will you rather have this term and a term out at the end? And you know, you're 35 today, you're 65 then. If they're above 50 and on, I just don't like doing it. I personally don't do it. And I always show illustrations where they are financially set for their future. So if I do it this way, I could beat anybody at this. They can bicker or argue with me all day long about this, but they're both good. And I'm not saying you're doing that at all, Ronald. I'm just saying a lot of people can come to me and say, look, I do a term. Why would you do this? Well, one, if they outlive this, what did they spend? They spent $100 to $300 a month. And if they're older, it's going to be $300 a month. It's going to be $600 a month to cover $200,000. You know what I mean? So why not have that earning interest? If I'm going to dump money into something and I know that it has the capabilities of earning interest, I'm going to dump it into the interest earning bearing products and have access to the money too. Why? Because of retirement. But like I said, either way is good. I'm not opposed to doing term. I just don't do it that way. So either way works though. If you can sell somebody a term, look, the bottom line is if it does happen, it's not, like in this case, it's not when, it's if. Because they have a timeline. They got 1 to 30 years 9 times out of 10, or 1 to 20 years, okay? Depending on their age. Now, if they're older, this is out. You only have 1 to 20, 1 to 10. That's about it. 1 to 15 if it's an option. 1 to 10, 1 to 20. So they got a 30-year mortgage. I'm only going to cover it for 20 years. It just doesn't make sense. By that time, I had $50,000 in well, dues are $300 a month or $600 a month. I got 50, 100 grand built up into this in cash value, and I'll just pay the back end of the house off instead of using this term product where you're renting. I don't know if you guys feel differently about it. Post it up, write what you want. I'm just telling you that in my scenarios, when I have a 50-plus-year-old individual and I can't get them return a premium, this way works a hell of a lot better when you illustrate it. If I show somebody you're spending $600 a month and at the end of 30 years you make it, you get nothing, or you make it 30 years over here, you walk away with 100 grand, which one are you going to choose? You know? Now, from a sales standpoint of view, it always makes sense to do the illustration, literally print it up, and bring it to the house with you. How do you know what to do with mortgage protection? Let's take that $70,000 I have. This one here, or this one here, which one? This one's 120, this one's 70, either one. I can take either one of these and know what to do. I'm going to separate the sheet. Here's $70,000 is owed on one of them. Here's $120,000 is owed on another one. This is for illustration. So if I'm going to type in, I'm going to type their age in, non-smoker, and I'm going to bring the illustration with me, guys, to the house. That way I can point out the cash values inside. I can show them in the illustration what it's done in the past. And this is very vital to the sale, showing people what their money could do over time. And if you teach them well enough what it can do, I take $70,000. If it's a 35-year-old, you want to do the whole illustration, pay the whole house off, but also get 1 or 2 products that buys time, 1 to 2 years. So you want to show an illustration at a high level and then do it at 1/2. Why? Because this will pay it off in 15 years. Half of this is $35,000 at 15 years. That'll be about the time. There's 2 timelines: 30-year mortgages, 15 years. Half is paid off. You die in 15 years. It pays this back end off. And this timeline here is the sell. This sells the home. So you need a small amount of money to keep her in place. They have $100,000 a month coming in. She's going to lose $65,000, as we explained. She has $35,000 a month coming in. That's $2,916 a month. $1,000 of that's gone, so she has $1,916 a month left over. Maybe they have a child. Maybe they have car payments. Maybe they have the lawn care. Maybe they have the list goes on. By the end of the month, she's probably left with $400 or $500 left over. All right? So you easily be able to take that money and help her invest. So in the younger people's positions, always put it on the breadwinner. If it's an affordability thing, just put it on the breadwinner or put it on both. Okay? So buy them time to sell the house, buy them time. Now, older people are different. You want to do the same thing, but you can't. This particular situation, I would buy time. I would buy half the way through. I would get a $35,000 policy and a $60,000 policy, and I would show them that. I would show them the cost on that, and then I would buy one for $25,000 to buy them time. If they don't like any 3 of those, I'll buy them a $12,000 policy that gets them $1,000 a month for 12 months and pays the house off, pays the mortgage until she's able to sell the home for the equity inside the house. Remember, you are there to protect the equity in the home. You're not there to really protect that home. As much as you want to ask the question in the house, Mrs. John, would you even live here if he was no longer here? Would you stay in this house? Now, due to health complications, you may not be able to. So what we want to do is always, always, always make sure that you always have enough money to walk away with the equity in the home. You know how tough it is to sell homes today? If you put this on the market, you think it's going to flip tomorrow? No, it won't. It might take a month. It might take a year. It might take 2 years to a volatile market. So buy them enough time and sell a policy. It's that easy. You know what I mean? Mortgage protection is not difficult. However, let's get into, let's take some time out and look at an annuity. Indexed annuity. Last thing I'll do for today. Indexed annuities. How do you get them? Where do you find these things at? Well, you can find them in final expense products. You can find them in mortgage protection. You can find them in friends, family, coworkers. You can find them everywhere. You should find one for yourself. You got $10,000 in the bank, put it towards an index annuity now. It'll double every 10 years. Smart move for you and your future. Stop being afraid to invest in yourself and your business and your future, because you're going to be one of these older people that's hurt one day. And if you do what I'm telling you to do, you'll actually learn these products a lot faster, and you'll be able to present this stuff a lot better because you actually have it on yourself. Next week, I would get an Index Universal Life. I would do an illustration on each and every one of you. Do it on yourself. Look at what it looks like, okay? Do an Index Universal Life. Pick one, high interest rates only, living benefits too. So long story short, Index Universal Life. Where did I get it? How do I find it? Well, it's in the questions that I ask. Okay, there's a certain amount of questions that I ask. Who has the two of the higher Social Securities? How much is the whole entire mortgage, 30 years? How much is the monthly mortgage? $1,000 a month. Out of the two of you, who owns the two of the higher Social Securities? Great. Also, Mr. Jones, are you going to be leaving her anything else? Like, do you have a 401k or 403b or thrift savings or savings account or any money in any way, shape, or form that Mrs. Jones will receive? Yeah, I have $50,000 in the bank, and I have an IRA, and I have a 401k. All right, there we go. Now, about what is she going to receive from this? The IRA is worth about $25,000, and the 401k is worth $400,000. Okay, so non-qualified, qualified money, you guys got to learn how to do this stuff, because what I would do is I would take a look at cashing all this in, getting one check, and having them, depends on the scenario, of course. I would say, Mr. Jones, you're doing a great job. You've got a lot of money put away, but you still can participate in downsides of the market. Let's take a look at no longer participating in the downsides of the market. I have this scenario next week, in fact. I have $430,000, $25,000 here, and $50,000 in the bank. I asked him, why not take a look at an illustration that puts all this money together? And guess what? I printed it out at his house at that time. Not all annuities will sell on the spot, so don't be pushy about this. That's why you got to present many. How do I sell 14? I think it was up 14 2 weeks. Maybe it was 12 in 2 weeks. I sold 12 in 2 weeks. I don't know if that's a record. Guys, I've sold 3 annuities in one day. I have done things like people can't imagine, but it's there for you too. I'm telling you it's there. And this is how you do it. I want to show you an illustration that blends all this money together. So if I take this, and I take this as $450,000 plus this is $75,000 plus $75,000 here. There's 5 here, got a 10 here. I'm going to take $500,000, and I want to get you a bonus. So how would you like it if I could show you how to make $50,000 today? I'll show you how to make $50,000 right now. No downsides. Nobody can ever take it from you. All upside potentials. Less tax payments. The investment is awesome. Check this out. I want you to take a look at this, Mr. Jones. So all your money together comes to $500,000, okay? Now, our companies want people to work with them. So what they're willing to do is they're willing to give you 10% of their own money just to get you with them. So they're going to give you $550,000 is where you start. So the great part about that is by next year, if we take $550,000 and we add 7% by a look back of just 10 years. If you were with the company for the past 10 years, this is what you would be at today. You'd be at $1.3 million in 10 years. If you were with the company for the last 10 years, that's what you would be at. Here's the facts. They're showing you that. So when you're doing the index annuities, you've got to have the illustration in front of you. You've got to get them to the point of allowing the illustration to be on the table. And that's where it's so simple that you make it almost difficult to talk about. You're confusing this. You're making index annuities very difficult. And all they are is a transfer of money. Transfer of funds, that's it, into a life insurance product. Very simply put, you take all the money that he has staggered out. You got the IRA, you got the 401k, you got the cash. You blend it all together. You show him how to make $50,000 plus 7% the next year, which is, I don't know, it's almost what, $600,000? Let's just say it's $600,000. It's under that. It's what, $580,000 or something? Something like that. Anyway, show them how to do this. Maybe it's $590,000. So in a year, 1 year, you almost showed this. Ask this guy, your stockbroker ever showed you how to earn almost $100,000 in 1 year? In 1 year, you've almost earned $100,000. In fact, you've earned $90,000 in 1 year. In the very next year, you'll probably be at $630,000. And then the point is we're going to make you a millionaire in your lifetime. Now, here's the great part about this is depending on the guy's age, this is $2.6 million in just 20 years. Now he's got enough money to last everybody a lifelong income. How do we know that it works this way? Well, just like all stockbrokers, look back on companies and what they've done in the history, and index annuities do the same. You take a look back at its performance in the past. So all you're doing is looking in the past, what the hell the thing has done. You can look back 30 years on some of these things and say, for God's sakes, every 10 years, people would have doubled their money if they would have done it this way and not the 401k way. And Tony Robbins wrote a new book on this stuff. Patrick Kelly's Tax-Free Retirement, great books to read. In fact, here's a good thing to do. Buy those books. Buy Patrick Kelly's Tax-Free Retirement or Tony Robbins. You can go to Tony Robbins' website and get it for the cost of whatever it costs to ship. It's like $6 to get the book, paperback. Long story short, it's all about index annuities, really. That's how Tony's guys never lost anybody any money during the deep depressions, the 2008 hits. That's where guys were making people money. You know what I mean? It was sick. It was insane. So at the end of this road, 30 years down the line, you get somebody, 30 years in the past, you take a look at these products and their performances, you're going to be blown away by the fact that they kept earning. And that's fantastic. You know, it really is. All right. Any more questions? Ronald, thank you for introducing yourself. And hey, on the webinar, Paul, you interested in, you already selling mortgage protection and annuities?
Yes, sir.
Okay. And you having good success at it, or do you need help in any areas?
Just watching you is awesome.
Oh, thank you. Appreciate it, Mike. Hey, so it doesn't say your last name, so if I know you already, I apologize. Let's see here. Anybody have any questions on Facebook? Anybody have any questions on Facebook? All right, so all I can tell you is this. The index annuities are in there. I'm going to go over this one more time real quickly. Index annuities are in the house. Where are they? They're in the questions that you asked. How did you ask them? You asked them in a way that pertains to protecting their loved one. Joe's protecting Paula. Paula's protecting Paula. They have a home. They got final arrangements. They got money they need. They got inflation. Looks like this. Here's tax increases. Draw this out. Here's inflation by percentages of 4% every year. Did gas go up for all you? It has for me. So here's a level income. Now, if these people are to survive, not only on a level income, but with 1/2 of that income, and usually less. The old man passes away. She has 6 to 12 months to wait for his money to captivate her lifestyle, and during that time, she has to wait. Now, with the way you're doing things, you can protect them from those downsides, which is the first downside in her life is the 6 to 12 month wait. That's going to hurt. That's where she's possibly going to lose the house first. You're welcome, Lawrence. Those books are great, by the way. You're welcome for the book. Get those books and make sure that you read the hell out of those books. I don't even have mine. Winning with People is a good one. Anything from John C. Maxwell is good too. But at the end of the day, there's the power of attitude. It all starts with your attitude too. At the end of the day, just like everything in life, there are days where I wake up or I am revved, I am fired up to get in that car and go, man. And I want to help people. I don't just do it for the money at all. I don't even think about the financial outcome is something I don't even look at. I don't look at it. I know it's there, but I don't look at it. I'm not like, hey, I'm going to go out and do this for this today. I do it for the financial benefits of the people that I'm working for. And I feel like they've already hired me. Like I walk in like I'm already hired to do the job, like they already put money down on me. And when I sit down, I act like that. I'm like, I got a retainer on me. I'm doing my job. And that's why I sell more than most people, because they just don't want to work with anybody else, because why would they? They get all the facts here. And the truth be told is if they go out and search for somebody else to come in and they come in and start pitching, term products or and things that they don't like, when they say, hey, look, man, you did an amazing job in your presentation, Jason. Why would we want to use anybody else? You nailed everything. There's nothing we haven't learned. We learned about everything while you were here. And once you learn how to present very quickly in a short manner of time in a positive way and show them that it's factual, it's going to happen, that you will win over people's lives, their money, and their hearts. Mr. and Mrs. Jones, how much is the total mortgage for 30 years? 200 grand. How much is the monthly mortgage on this? Is $100,000 a month. Out of the two of you has the two of the higher Social Security incomes. And Mr. Jones, are you going to be leaving her anything else? That's it. That's where you find your annuities. That's it. Mr. Jones, are you going to be leaving Mrs. Jones anything else? And give them a little help. Have a list put together for yourself. 1, 401k is a good one. Okay? 2, 403b. Remember these and call them out. 3, savings. 4, IRAs, stock-based products. You call this stuff out. Say, Mr. Jones, do you have anything like a 401k, 403b, savings account, IRA, stock-based products that Mrs. Jones will receive when you pass away that can help her get through the 6 to 12 months? I explained why I'm asking, which is good for you to do too. This takes all the prying out. Do you understand? When you don't pry, they want to offer the information. Oh, he's not prying. He's really here to, he knows, it sounds like he knows what the hell he's talking about. And he's really helped Paula out here. I really need to know this too. How much am I leaving her? They really don't talk about death and this shit. So when you're there, get them to talk about the things they don't talk about. This is the stuff they're avoiding. When you make it kind of fun and exciting to look at their own numbers, it can be fun to watch their numbers grow and watch people get help, as long as it fits in the budget. So at the end of the month, Mr. and Mrs. Jones, you have $500 to $1,000 left over. Which one are you closer to? Well, closer to 500. Well, I know I can get a $100 policy out of them. I can push 200. With 1,000, I can go up to $500 a month, even 6, 7. And make it stick. Why? Because I'm learning to get them either the money back or earn them money. But with the indexed annuity, you want to find it first, okay? As soon as you find it, then it's this. Okay, I told you today I'd like to get all your options on the table. So what I'd like to do is make sure that you understand all your options. You guys fill out a lot of these cards? Yeah, we filled out like 5. In our case, we're the first one in the door. So when you work through me, you get the first one in the door, and through my new lead program, you're the only person to sit with these mortgage protection individuals. How would it be if you could be the only individual sitting with them and just talking about mortgage protection? You're the only rep talking to them about it. How can you lose? As long as you put all this in front of them, you can't. You're getting something out of them. It's no longer 50-50 out in the field. It's more like 90% sales ratio. You know what I mean? You sell at a 90% sales ratio. If you're sitting with them, as long as you sat with them and you use these presentations, you will sell something. It's been proven over and over and over again. So the index annuity, next, I'd like to show you all your options. Okay? So do you have a computer I could use? Yes. Does it have a printer? Oh, great. Here, may I use it? I need to print something out for you to take a look at. Sure. Okay. Well, get in front of the computer, make the call. Call your carrier up. Tell them I got a 50, 60-year-old male, has a $500,000. I want to get the highest interest earning product that you have, and I want to give him a big bonus. Can I give him a 10% bonus? If you're new at this, these are the questions you need to ask. I want to get them the highest interest performing product out. So that when I show the illustration, the proof shows in the past 10 years that they would have doubled their money. Just tell the carrier you want to show that it doubled their money. And I want to get them the largest bonus. So in this case, you've had $550,000. because of the bonus, and then show them the very next year, you know, and then show them in the 10-year line, and then show them the 20, 30, 40, 50 years. These people will be multi-millionaires through their family. Here's what you want to tell them too. Joe and Paula, what you'd like to do is make sure that when your kids inherit this, that they do the same thing you did. So maybe you want to split all this up, but to have each one of your children doing annuities, and I've done that for families too. I've taken the death of the individual and I've split this, and I've done, in fact, it was $550,000 because the guy had $500,000 and I got him $50,000. I said to this guy before he passed away, unfortunately he passed away even before the annuity went through, that I said, how would you like to earn $50,000 today? And he said, all right, you got my attention. We showed him the illustration. He was in an IRA, not going anywhere, up and down. And in fact, a couple months before, over a few months, he'd lost $50,000 due to some market decisions he made. And I was like, how would you like to get that back? So I made him his 50 grand loss back. So it's very interesting, some of the stuff you could say, you could say, all the money you've ever lost, I can get it back for you in an instant. And you'll never participate in any downsides of the market potential. Which carriers do you use for your annuity sales? Well, I tell you what I like to do, Lawrence, if you could text me over that. I don't like to answer that over here. I don't talk about carriers on this. Just because there's a wide variety of people. I promised everybody that I wouldn't recruit during this, so I want everybody to enjoy this and get the knowledge they need. If you decide to join my team, then so be it, but I'm not here to recruit. I literally am here to coach. So, just text me over that, and I'll tell you who the carriers are. How about this? I can tell you some great carriers, though, without telling you who I use. There's companies like Athene is a great carrier. And bottom line is one of the best out there. You got North American. There's a company Guggenheim. There's quite a few. It really depends on you when you do that. But there are some easier companies to work with through my experiences. I just make the ride a lot easier. The telephone calls, they're a lot smarter on the phone, things like that, and they do the best job at this. So when it comes to illustrations, you always want to show the highest interest earning product with the biggest bonus when it comes to annuities. And you will win the hearts of your clients over. And all you did was show them an illustration. Guys, you didn't sell them anything, okay? So remember, if you haven't written an annuity yet, get the paperwork in front of you and start walking through it. If you don't know how to do it, get the carrier on the phone and walk through step by step when you're with the client. Tell the carrier, this is the first time I've written this out. Right in front of the client. Doesn't matter. As long as you got the sale done and the close, doesn't matter if you're new at it or old at it, just get the paperwork. It's very important. It's very vital that they know. There's suitability to these things too. So if I take this guy's $500,000 and they find out that he has no money left, then they may not make him suitable for this. So you got to be aware of suitability for annuities. How much is your yearly income? $100,000. They want to know how much money he's earning a year, how much assets he has, because they don't want anybody putting money away and then taking it right back out after they've earned a couple bucks. You know what I mean? Even though there's penalties against that. I'd say one of the only downside penalties is this: 10, 9, 8, 7, 6, 5, 4, 2, 1. This is the penalty. This is 10%. So if this individual were to take his $550,000 and he wanted all this money back, they're going to charge him 10%. All right? So they're at 9%, 8%, 7%. So you have to make sure that they're in this for the long haul. And once they get to these smaller numbers here, they've earned so much damn interest anyway, this isn't going to kill them to pull it out anyway. So tell them not to threaten. If you're averaging 7 to 13% annually, and you can prove it, these smaller numbers won't affect them in the longer run. So anybody have any other questions? Ask before the week starts, man, before you get out there. You have your lead orders in? Be the first question I ask myself. Am I prepared? Do I have my leads ordered? Am I ready? Lawrence, thank you. If you guys do want to, take a look at more options for your own career, I highly advise that we all take a look at the, all our options when we're a 1099 life insurance business owner sales rep. And, I'm going to put my telephone number here so you guys can be aware of all your options, okay? That is an option. And then anybody on the webinar that has any questions before we... Hey, who's 708-715-1689? You have any questions? Are you a licensed life rep?
That's me, Jason Paul.
Oh, Paul, you on here? Looks like you're on here 2 times, though.
Yeah, I don't know why.
Is there another Paul on here? Or is there one Paul? Is there 2 Pauls on here or just one? Let's see if there's another.
That's me.
Got it. Anybody on Facebook have any questions? At the end of the day, we all wake up. It's about people. It's about, it's about the future. It's about money. It's truly about what you can do for the individual. So my systems work, guys. They do. But I don't know how you're going to use them. When you won't know until you use them. You know what I mean? It's kind of what I'm trying to say is, until you're in front of people, you're not going to understand what I'm talking about here to its fullest length and all the way in depth. You have to get in front of people to really truly understand what I'm giving you. I'm giving you the keys to the kingdom, man. I'm giving you every tool that I use, not everyone, but I'm giving you a lot. Till you join my team, that's when you get them all. But you truly can master this, and you want to master this in a short period of time because you're wasting people's money and your own. So, getting people from point A to point B to point Z is where you need to be. So here to here is your sales. Here to here is an agency. This is mastering just sales. This is mastering A to Z, is mastering agency and sales. And this is where the big money is. So you got 100K a year coming in here, and you got 100K a year coming in here. And then once you walk away from this, you have this to ride, and then you take this to $1 million a year. Because now all your efforts are towards these people. But you need to get through all this to be able to teach people. I used to recruit early in the game and never understand why people would just tell me, no, don't recruit, you're not ready yet. I always felt like I was ready. I was pretty good at this from the beginning. I wasn't real good like I am now, but I was okay at it. And I felt like I had duplicated, but I was lying to myself. So I couldn't, not at this level that I teach now. So what I want to do is make sure that you're all aware that every step isn't just another day towards maximizing your solution, which is, hopefully retiring wealthy and having a great income. And I do mean retiring wealthy. Why would you accept anything less? Those of you that are in this to make a few bucks, that's your mentality is just killing you. I only want to do $1,000 a week. That's why say that to yourself? Why not just say I'm earning $10,000 this week, and if you make $1,000, then you're okay too. But your attitude does mean a lot. And walking into this, I would say that you have to have a great attitude. You have to have money to fund this. Without these 2 things, you're doomed. You have to have the carriers. And you have to have the knowledge. Now, not total knowledge, but do some of you may not even know when the inception of a company was. And I'm to blame too. I'm just saying these are for all of us that we're guilty of this stuff. Like the inception of the company. When was the company created? God, let's learn that stuff at least. You know what I mean? You can talk about that. This is a great curator. They've been around since 1878. Any company that's been around for over 100 years, they must have something great to offer, you know. So it's great with a great attitude and good money to start. You can go places nobody's ever gone before, like Star Trek, you know. It's like crazy what you can do, but you need the startup capital. And those of you that come on board, I'm not hiring anybody that's broke anymore. I just won't do it anymore. If you don't have any money, I refuse to take that challenge on, because I have in the past, and I've made all these strategies and techniques and what have you, and I put it in front of people, and they just don't grab it. They just don't even use it. They won't even go out and buy B leads. If I were you and I wanted to impress me, because I would want to impress me to get my knowledge, I would be on the phone. Like I would say, Jason, could you do me a favor? Could you listen to me on the phone? Can we do a dial session together? Can we go out in the field together? I have several people that do this, and these are the ones that went like a little bit of time spent with me. Boom, they went right to the top. Just that they needed a little twist in what they were doing. Just that little bit, a little angle that they need. They need a little shift to do it, say it some other way, or practice it some other way, or talk about it some other way. Once they did that, though, their incomes are through the roof now. I can only hope that each individual surpasses my income. That's what I hope. I hope all of you make more money than me. But you're on my team, at least. I really do. That would mean that I got some genius stuff here, and it works. And I want to know from you what you think about the systems and products that I offer here. You know, because this stuff isn't going to be free forever. This is only limited time offer here, guys. And then I'm posting it up, and it's either you're on my team or it's going to cost you to get involved. So it's not free forever. I've done this for a while now, you know, to recruit and get people on board. But you would think that all these people out there and the failure week in, week out, and how they get treated at these carriers and companies and IMOs and NMOs, that they would see the light by now. But they're so brainwashed by companies that they don't understand. And that's a crime. It really is. But listen, that's it for today, guys. Thank you again for coming on board. And I just wish you the best this week. If you have any troubles, give us a call or a text, and we'll hopefully have the answers for you. We'll rewatch this video, watch all the videos, and study hard, okay? Thanks for another great week.